Okay, so let's start with this question. Goliath company. Have a quick read through. It's to do with net present value. Okay, so we already did a question very similar to this not last week, the week before that, right? We did hayback, if you remember. Very similar, just a few differences. That's how NPV questions will be, right? 90% it will be the same. There will be a few changes from question to question. So again, the more questions you do, the more you will get exposed to these small changes that they can make. Okay, right? So have a quick read through and then we can try out A part. So A part is a calculation, B is just a theory based question, C is also a calculation. Okay. Okay, so let me read through this question. Okay, right, so it's saying Goliath company is a listed company which plans to meet increased demand for its products by buying new machinery costing 5 million. Okay, so what is the the problem that they have? They're trying to decide, okay, is it worth buying the new machine worth 5 million or is it not? Okay, the machinery would last for 4 years. Now these things you have to note it. Okay, so first thing you have to know is that the price, first thing you have to note down is that the price is 5 million and the life of that particular machine is 4 years, at the end of which it would be replaced. Now this replacement is actually important, right? Usually in NPV questions we use a machine, we scrap it and that will be the end, right? We don't try to buy another machine to replace, no. But in this case they are replacing, so something might change there. Okay, scrap value of the machine is 5% of the initial cost, so that is also there. Scrap value is also given. Tax allowable depreciation would be available on the cost of the machinery on a 25% reducing balance basis. So tax allowable depreciation is going to be 25% with a balancing allowance or balancing charge claimed in the final year of operation. So that is normal. Tax allowable depreciation at the last end of the 4 years we will have either balancing allowance or charge. The investment will increase production capacity by 9,000 units per year and all of these units are expected to be sold as they are produced. So the thing is, if you buy this new machine, our production capacity is going to increase by 9,000. Okay, so that is the good thing about this investment. Relevant financial information in current price terms is as follows. Current price means we have not inflated at all. Okay, so we have the selling price which is 650 per unit, but we forecast an inflation of 4% per year. The variable cost, we have it currently at $250 per unit, but again we are forecasting inflation of 5.5%. Incremental fixed cost is 250,000, inflation for that will be 5%. In addition to the initial cost of the new machinery, initial investment in working capital of 500,000 will be required. So there is a working capital situation as well. They are saying the initial investment will be 500,000. Investment in working capital will be subject to the general rate of inflation, which is expected to be 4.7% per year. So here they are talking about working capital and how that will increase. Then here they are speaking about tax allowable depreciation. Okay, Goliath pays tax on profits at a rate of 20% per year, 1 year in arrears. Okay, so this is a normal situation. The company has nominal after tax cost of capital of 12% per year. They are asking you to calculate NPV. Okay, now here Selling price has a separate inflation, variable cost has a separate inflation, fixed cost has a separate inflation. So clearly you can't use the real method. You have to use the nominal method where you have to inflate everything and then do the calculation, right? So let's start off by inflating selling price, variable cost and the incremental fixed costs. Right, so this is how I would structure it. I'll call it sales revenue. Okay, I'll call it working number 1. Okay. So selling price currently I know it is how much? Let me check. Currently selling price is $650 per unit. But now in year 1 onwards, it's going to get inflated by 4%. So I will get the inflated figure. So currently it's 650. So I'll just put year naught, or don't, because it usually year naught's figure we don't put it now in the pro forma. So let's just keep it in mind that it's 650. And year 1, 2, 3 and 4, let's inflate it. So here it will be 650 into, the inflation rate was 4%, right? So into 1.04. So that will be 676. So here it will be, you can actually take 676 and multiply that by 1.04. That will also give you the inflated figure. 703. And here 703 into 1.04. which is 731.1616, and here it will be this into 1.04. So every year I have inflated it. So I put it to 2 decimal places. Okay. So that is the selling price inflated. So I'll just put inflated selling price. Okay. So now if I multiply it by the number of units that I can sell, that will give me the sales revenue, right? So if you look at the question, how many units am I going to sell? They're saying the investment will increase production capacity by 9,000 units per year. So every year I can sell this additional 9,000 units. So that will be the sales units per year. I think one of you, I'm not sure if it was Basit or whether it was Tarushi or Yumna, one of you had inflated the sales, right? They didn't tell you that 9,000 is going to increase, right? They told you that every year you will sell 9,000 more, but they didn't talk about that figure increasing, right? So that was the error there. So you have sales revenue, which will be this into 9,000. Okay, so that will be, I'll do it in thousands. Okay, so I'll convert it to thousands in a bit. Right, so let me do this in thousands. Sales revenue, it's easier if it's in thousand. So this will be 6084, this will be 6327, this will be 6580, and this will be 6844. You can put the whole figure, not a problem. I'm just doing it in thousands because it will make my statement look nicer. Okay, that's about it. Right, so that will be the sales revenue story. So now we need to inflate the variable cost as well. So I'll do that. Call that working number 2. Okay, so if I go back to the question, currently the variable cost is 250. It's going to inflate by 5.5%. Okay, so let me do it for every year. 1, 2, 3, 4. variable cost. Currently it is 250, right? Yeah, 250. It's going to inflate by 5.5%, so 1.055. So that will be 263.75 in year 1. Year 2 also it will inflate by the same amount. So in your exam you will be able to kind of drag the same equation across, right? I am not able to do it because this is the iPad's version of Excel. Okay, right? So let me take this to 2 decimal places. Okay, so that will be the variable costs. Now to this also I will take the sales of 9,000 and do the multiplication. Okay, so variable cost will be this into this. Okay, so I have just done the multiplication. I'll type it in thousands as well. So it will be easy for me to copy into my pro forma. So this will be 2374, 2504, 2642 and 2787.
2505.
Where?
2505 in second.
Yeah, okay, 2504. Right. Okay, so I'll just highlight this, so it will be easy for me to take the figure that I need, right? So I need to take this to the statement and I need to take this also to the statement. Okay, so I have inflated both the sales revenue and the variable cost. Now there was an incremental fixed cost, right? So that also I will inflate. Okay, so here 1, 2, 3, 4. So if you look at that incremental fixed cost, it was 250,000, which is going to inflate at 5% every year, right? So year 1 onwards, I will inflate 250,000, and let me do that also in thousands, so it will be easy for me. Okay, so this will be 250 into 1.05. Okay, so that will be 262.5. Then this will be this into 1.05. Okay, this also you can take it to the nearest whole number even, no problem. Okay.
Third didn't change.
Sorry?
Third didn't change.
Oh, sorry, why is that? Because I have put into 1. Okay. Right. So let me reduce the decimals. Okay, so this is only the incremental fixed cost. This has to go to the statement. So this also I will highlight it. Okay. So now I have this, I'll call this working number 3. Okay, now I have done most of it, right? So if you look at the question, I have taken the selling price, I have taken the variable cost as well as the incremental fixed cost. Now after this I have to do tax allowable depreciation and working capital adjustment. Now before I do tax allowable depreciation and working capital, I have to take certain totals. Okay, so in the NPV pro forma, there are certain totals that I have to take. So I will go ahead and start on the NPV also. Okay, so let me just leave some space here. Okay, I'll just leave some space here for tax allowable depreciation. Allowable depreciation. I'll call that working number 4. Okay, and another space for working capital. And I'll call that working number 5. Okay, I'll come back and do this. Meanwhile, let's do the net present value. Okay, let's do everything in thousands. Okay, right, so I will have year 0, year 1, year 2, year 3, year 4. I might need year 5 because taxes are paid in arrears. Okay, so I will start with the sales revenue which I have in working number 1. So I will copy that. Over here, that's the sales revenue. Okay, I need to push this a little to year 1. Okay, so that's the sales revenue. Then I will take the variable cost. This also be careful, okay? It has to come under year 1. And then I have the fixed cost. Okay, so at this point I need to take a total. That's what I was trying to say. Okay, I'll remove the highlights because it's the statement, you don't need to have it highlighted. Okay. Right. So here I'll take a total. I'll call that the cash flow before tax. Okay, so how do I take that? That will be the sales revenue minus variable cost minus sales revenue minus variable cost usually you should be able to do it, but it's fine. Okay, in this case I'll just take the deductions. Okay, so what I will do is, since that's giving me trouble, I will put these as negative figures. Okay, so minus 2374 minus 2504 minus 2642 and minus 2787. Because if I do it like that, I can take the sum. Okay, so that way it will anyway automatically subtract 263. Okay, so all of that is there. So here what I will do is I'll take the sum of this entire column. So that will be 3447. Okay, I'm not able to drag it. This is totals, okay? Okay, and let me take it to the nearest whole number. Right, so that will be the cash flow before taxes. So I can take, I'll just bold this. So now what I will do is I will calculate the tax figure. Okay, so I know the taxation rate was how much? Tax on profits is 20%. Okay, so I will calculate that directly, but it is paid 1 year in arrears, right? So 20% of 3447 has to actually come under year 2. So this will be this into 20%. So that will be 689. Here it will be 3547 into 20%. It will be this into 20%. 20%. Okay, so this also, let me round it to the nearest whole number. Okay, so those are the taxes. So now that I have tax, I can do the calculation for tax allowable depreciation, right? So let me go back. I had kept some space here. Let's try how to do tax allowable depreciation. So So what did they tell me about it? They told me that tax allowable depreciation is 25% on a reducing balance basis, and I know that we are paying in 1 year in arrears. Okay, so it's just a normal tax allowable depreciation calculation. Okay, right, so we have the years 0, we start with year 0. We had an initial investment, which was how much? For this particular machine, initial investment was 5 million. Okay, so let's do it in thousands. Okay, let's do it in thousands. So 5 million means we are talking about 5,000. Okay, so initial investment is 5,000. To this, in year 1, you will claim tax allowable depreciation at 25%. So 25% of 5,000, you will claim 1,250. Okay, so this 1,250 you will actually deduct it. Okay, so at the end of year 1, you will have a written down value of 5,000 minus 1,250, which is 3,750. Okay, then in year 2, what will happen? Again, you will have this tax allowable depreciation 25%, but this time it will be 25% into 3,750, which is 937.5. So minus 937.5. So written down value 3,750 minus 937.5 will be 2,812.5. Okay. Year 3, same thing. Have the same tax allowable depreciation, which will be 25% of this figure, which is 703.125, right? So I'll take it as 703.1. Written down value 2812.5 minus 703.1 will be 2109.4. Okay. In year 4, you will scrap it off, right? So you have the disposal or the scrap. They told me how much was scrap value? 5% of the initial cost. So initial cost was 5,000 means scrap value will be 5% of that, which is 250. Okay, so this figure you will deduct it, and then you will get either balancing allowance or charge. We'll see what it is. 2109.4 minus 250, it's a positive 1859.4. So this is actually a balancing allowance. Okay, right, so let me just bold the tax allowable depreciation figures, because that's what we need, and the balancing allowance. So now if you want to find out the tax savings, you have to basically take your tax rate, which is how much? 20% per year. Take the tax allowable depreciation figure, multiply it by the tax rate, which is 20%. So 20 into 1,250. Okay, I'll put the working as well. So this will be 1,250 into 20%. You don't have to show this in your exam. I'm showing it just for you to learn. Okay, 937.5 into 20%. 703.1 into 20%, and finally 1859.4 into 20%. Okay, so the tax savings you can calculate it easily, which will be 250 in year 1, then 188, then 141, and finally 372. But we are not done yet. Be careful with the timing, okay? Because we are paying tax 1 year in arrears, right? 1 year in arrears means this tax savings that comes under year 1, you will actually realize it 1 year later in year 2. This will happen in year 3, this will happen in year 4, and this will happen in year 5. Okay, so be careful when you are putting it in the pro forma. You should put it under the correct years. Okay, So now we can go ahead and put these figures into our NPV table. So we'll call it tax allowable depreciation. Working number, what was that? Working number 4. Okay, so under year 2, we will have how much? 250. Under year 2, 250. Then year 3, 188. Then 141. And 372. Okay, so that will be the tax allowable depreciation figure. I'll put the tax as negative, so it will be easier for me. Sorry. I'll just put the tax figures as negative, so minus 689, and this is minus 709, minus 730, and minus 751. So it's easy for me to take a total, right? In your exam you won't have a problem. Thing is, here I am not able to add and deduct more than 2 cells. Okay, so that's why I am putting it as negative. So I can just take the addition of the entire column just for ease. But in your exam, you will be able to, deduct one and add the other one. So that shouldn't be an issue. Okay. Right. So then we have the tax allowable depreciation. That's fine. Last thing we need to get is the working. Yes.
Do you have people online?
I'm sorry?
Do you have people online?
Yes, I do.
How many?
9.
We have event tomorrow. Halloween.
Halloween, okay.
Yeah, we are here to promote.
What?
We are here to promote.
Come.
Yeah.
Yeah, you can come.
4 p.m.
Guys, this is Tabish. What's your position? President of the Student Council. He wants to say something about Halloween.
Hi guys, we are having a Halloween event tomorrow. 4 p.m. onwards, we are having a DJ, we are having a costume contest and everything. So, y'all can join us if you want. It's tomorrow, starting from 4 p.m. to 10 p.m. onwards, or it might go on. So if there's anything, you can message me. My number is, can you type that?
Yeah.
076 155
Okay.
6436.
Okay.
Yeah, it's a dress.
436, yeah.
Costume and there's a price.
Okay.
So yeah, if there's anything, message me. 6436.
Sorry.
That's fine.
Okay.
Okay. See you guys. Thank you, miss. Thank you very
Okay,
much.
no problem. Okay, so this is Tabish's number. You can contact him if you have any queries.
Make
Okay.
the transfer and fill the form. Thank you, miss.
Okay. Okay, so the last adjustment that I have is that of working capital. There is a small catch, okay, when it comes to working capital. So please pay attention, okay. So I hope this is fine. I'll just put it over here. Okay. Right. So if you look at the question and you look at working capital, they are telling you, in addition to the initial cost of the new machinery, initial investment in working capital has to be 500,000. And they are saying investment in working capital will be subject to the general rate of inflation, which is 4.7% per year. Okay. So let's just do the normal calculation. First we will see what the total working capital will be and what's the incremental working capital. Okay. So if you look at this, they say obviously working capital has to be in place in year naught itself. I'm sure you remember that. Year 1, year 2, year 3, year 4. Okay. So if you look at the working capital requirement, this also let me do it in thousands itself. Okay, in year naught it was supposed to be 500,000. Okay, so year naught I will keep it as 500, that's fine. Then after that they are saying every year it has to increase by 4.7% now. So in year naught it will be 500 into 1.047, which will be 523.5. So every year I will increase it by 1.047, 4.7%. Okay, so let me take this to 1 decimal place maybe, or 2 even. Okay, so this is the working capital requirement. Okay, so now we know that we only take the incremental working capital required, right? So this will be incremental working capital, right? So in year naught we have not invested anything in working capital, so the entire 500 you will have to invest. Okay, then in year 1 we need 523.5, but we have already invested 500, right? So only the extra 23.5 you will invest. Okay, so that is fine. Then if you look at year 2 we need 548.1. We have already invested 523.5, so what is remaining, the extra only we will invest. So that will be the subtraction of these two numbers. 24.6, that's what we will invest. Okay. Then in year 3 you can see 573.87. We have already invested 548, so only the remainder we will invest, which is 25.76. And now the catch is over here, right? Now usually if you are going to sell a machine and it's not going to be replaced, meaning you are going to sell it and that's about it, we will say the entire working capital it can be released. In the last year we say that, right? The entire working capital it can be released. But in this question they said after this 4-year period the machine is going to be replaced. Can you see they are saying it's going to be replaced. That means if you have already been investing in working capital, you can't suddenly take all that working capital out, because there will be another machine that is coming in. For that machine you have to put in the working capital required, right? So in this particular question, since the replacement is happening, the entire working capital we don't consider it to be released back into the company, right? So in this case we will continue with the normal incremental working capital itself, which will be 26.97. Okay, so I'll repeat myself again. Usually when there is no replacement, okay, in the last year this point we will basically we will put 573.87 and say the entire amount has been released back into the system. Okay, but in this case because there is a replacement we can't do that, because once the new machine comes we have to still cater to the working capital of the new machine. So we need to continue this working capital until the day where you sell the new machine and don't replace that particular sale. Yeah, it's like this, right? Can you remember how to do normal working capital? It will, until year 3 it will be the same. In year 4 what we will do, the last year we will say the entire working capital has been released. So 573.87 or 600.84, whatever it is, we will say everything is released, that's it, finished. But in this case the machine is not just getting sold and we are not forgetting about it now. With that money we are going to buy another machine to replace. So the moment you replace it with another machine, that machine has to run. So for that you have to put in working capital, if not it can't run. So we have to consider this working capital cycle to continue in this case. So that's why we are just taking 600.84, subtracting 573.87 and taking the 26.97. That's the difference between this question and all other working capital questions. That replacement factor. Got it? Online got it? After you can do everything under one row. I'm sorry, I just saw your message. Whatever is comfortable with you, you can, but make sure whatever you do is clear for the exam. Okay? Right, so let me just take this to the nearest whole number. It's working capital now. Okay, so incremental working capital, this also has to go to the statement. Okay, so let me put it here. So this has to come correct, right? Year naught itself, the 500 has to be there. Fine. The 524. Why is this 250? It's not 250, right? This has to be 25. Then this has to be 26. This will be 27. Okay, so all of them I'll make it negative figures. It's there correctly over here, okay? Okay, so this will be minus 500, minus 24, minus 25, minus 26 and minus 27. Okay, so that's it for the incremental working capital, right? So I think I have taken everything that I need to. Tax allowable depreciation, working capital, everything is done. Okay, so now I can take a total and get the present value. So I'll call this the after tax cash flow. So this, I forgot one thing. I forgot the initial investment and the scrap, right? So I'll just take that as well. Initial investment, that will be 5,000. Okay, and the scrap, which will be 250 at the end of year 4. Okay, right, so now I can take totals. Minus 5,500 for year naught. $6,870. 1 second, I made a mistake there, okay? Because 3,447 is already a total, you know, so I can just start from there. So 3,447 minus 24 also will do the trick. So that will be 3,423. So from here take the sum, okay? Okay, so minus 379. So I'll just check if the totals are there. Minus 5,500, 3,423, 3,083, 3,101 and 3,387. Okay, so all of that is there. Now let me discount it. Discount factor. They told me the rate was nominal after tax cost of capital is 12% per year. So the rate is 12%. Okay. Year naught is always 1. Go to the tables and take the figures for 12%. Tables will be there. So present value table 12%, 0.893, 0.797, 0.712, 0.636 and 0.567. Okay. So 0.893. And 0.636. Sorry, 0.636 has to come here and 0.567. Okay, so now just take the present value at 12%. Minus 5,500. Multiplying these two figures, okay? Right, so let me take this to the whole number. So now if I want the net present value, that will just be the sum of all these numbers. Okay, so 4161. Okay, so always remember to say this: the project has a positive NPV, which indicates that it should be undertaken. Okay, I think Basit, when you had done it, you had not given me that last line. This last line alone is 1 mark. Okay, right, so that's how you do the NPV. Okay, so you can cross check, those of you who did it, cross check to make sure that all the figures are there. Okay, so if you look at the question, what did they ask me now? They asked me to get the NPV, which I have already got. Then they are saying comment on its financial acceptability, so that also I have done. Okay, right. So I'll give you a minute if you want to, cross check anything, and then we'll do B part. Okay, done. So I think, I'm not sure if it was Yumna or Tarushi, one of you had got the tax timings wrong. Right, you had calculated everything correct, but the timings were wrong. Okay, so you had forgotten about that earlier story. Most all of you didn't get the working capital because that is something we haven't done so far. But otherwise, more or less, you had got more than half the mark. So that's a good sign. Okay, so do more and more NPV questions. You will see how they will give you different scenarios. So here, what is new is the fact that the working capital was treated the way it is. Okay. Right, so that is that. Let's look at B part. It's a theory based question. It's saying discuss the difference between a nominal or money terms approach and a real terms approach when calculating NPV for 4 marks, right? So it's a very simple thing. Okay, the thing is, when you have cash flows, you can inflate it and then carry on with the calculation, or you can choose to do NPV without inflation. If it is the nominal method, you have to inflate all the cash flows and use the nominal after tax cost of capital. In this case, it was 12%. If it was the real method, you won't do any inflation, but you will use the real rate. How will you get the real rate? You have the nominal rate, you have the inflation, use the Fisher equation, get the real rate, and then go ahead with the calculation. This case, you can't do it because there are specific inflation rates. If selling price, variable cost, fixed cost, everything was getting inflated at the same percentage, you can use real method. But here, since they are inflating at different percentages, you don't have a choice, you have to use a nominal method. If you can just mention this, and easy 4 marks. Okay? Right, then it says, Goliath has been given the option to lease the asset instead of purchasing it. The lease payments would comprise of 4 annual payments of 1.35 million paid in advance, with the first payment being at the start of Goliath's accounting period. The present cost of purchasing the asset is $4,097,000. Post-tax cost of borrowing is 8%. Okay, so this is a classic lease versus buy decision. The buy's answer is already given to you. So you don't have to do any calculation to do with the buying, because they are telling me that the present cost of purchasing is 4.097. Right? So the only calculation you need to do is to get the present value of this leasing option. So they are telling me 4 payments, 1.35 million is paid in advance, right? So usually I tell you it's best if you can, have a small timeline to show you what's happening. So you have your, okay, so you have year naught, year 1, year 2, year 3, year 4, and I'll take year 5 also. So what's happening in year naught? Okay, so if you look at year naught, you are going to have lease payment of 1.35 million. So one will happen here, one will happen in year 1, year 2 and year 3. So that is the 4 lease payments done. Okay. Then for these lease payments there will be a tax savings. But if you remember, when it comes to leases, the savings happens 2 years later. Okay. So this is something we already discussed. So for this 1.35 million, for example, the tax savings will start in year 2. So that will be 1.35 million into 20%, which is, I'll put it over here. Okay, the tax savings will be 270,000. So that will start here. So 270 here, 270 in year 3, then 1 in year 4, 270, and 1 in year 5. So these are the only cash flows that we have to consider when it is the lease payment. Okay. So why is it 2 years later? I already explained it at the beginning. It's like this, since it's year naught, right? By the time you claim any tax savings, it will be year 1. So anything that you are claiming for year 1, if taxes are paid in arrears, you will be able to get the benefit only in year 2. So that is why it ends up coming to year 2. Year naught's figure ends up coming to year 2. Okay. Right. So just a matter of getting the present values over here. So I'll put it in an Excel sheet. Okay. So this is the C part. Right, so I have the lease. I have years naught, 1, 2, 3, 4, 5. Okay, so in year naught I will have the leased cost. It is 1.35 million, so 101,350,000. That will happen for 4 years. So 1, 2, 3, 4. Then the other payment will be the tax. The other cash flow will be the tax savings. Year 2 onwards, you will have 270,000 for 4 years. Okay. So now what you have to do, take the net cash flow. Here it will be the same. Here also it will be the same. Here you have to do a deduction. 1,350 minus 270. Same here, and here it will be 270. Okay, so in the first 3 years it's actually a cash outflow, right? Because the least cost is more than the savings, so overall it's a negative cash flow. Whereas year 4 and 5 it's only the savings, so that will be positive, right? So I think it's better to put it as negative itself. This will be right. So that's the net cash flow. So now what you need to do is get the present value. So they told me to use how much? 8% post-tax cost of borrowing, right? So discount factor at 8%. Here not, it will be 1. Go to the tables, 8%, it will be 0.926. 0.857, 0.794, 0.735 and 0.681. Okay, so then we can get the present value, this into this figure. So you can drag it down, since it's vertical I can also do it. Okay, so then you can take a total over here. Which is 4,860,000. Okay, so this is the present value of leasing. Okay, now what you need to do is you need to compare this with the present value of buying. So if you look at the present value of buying, it is 4,097,000. Present value of leasing is 4,860,000, right? 4,097,000 Here it is 4,860,000. Okay, so actually you can see present value of leasing is lesser than the present value of buying, which was a negative 4,097,000. Okay, so cost wise you can see that leasing is cheaper, right? So this particular company should go for the lease as opposed to the buying option. Okay, both will cause you cash outflow. Okay, both are expenses, but the leasing is less expensive than buying, so we will go for the leasing option. So I will say that as the lease cost of 4,860,000 is cheaper than the buying option, Goliath company should choose to lease the asset. Okay, so that's it. That will give you the marks that you are looking for. Take it down because I don't think you guys had got this. Any questions, guys, online? Are you okay? Okay. Done? Any questions online, guys? You have to ask, man. If you don't ask, then you won't learn. Okay. Right, so that will be this particular question, right? So that's it for question number 31, 20 marks there. Okay. Right, so 32 is from cost of capital. It's a very, very common question from cost of capital. So please pay attention to the way we are doing it. Okay. So it says here, Oxfield Company, a listed industrial company, is considering a major investment. The company's investment projects team needs an appropriate rate at which to discount the estimated after-tax cash flows for the investment. So they are saying this company also, they may be doing something like what we did. They may be trying to calculate an NPV. Okay. Now for that, they need a after-tax cost of capital. Now here, they already gave it to me, 12%. So this 12% only we are trying to find for this Oxfield company. Okay. Following the company's normal practice, this is to be based on the weighted average cost of capital. So how are we going to do the calculation? Based on WACC. Figures relating to long-term financing are as follows. I have 160 million ordinary shares. Each share is worth $0.5. So total is 80 million. Share premium account is there. A revaluation reserve is there. Retained earnings are there. 8% preference shares of $1 each is there. 7.2% loan notes are also there. The loan note interest for the current year has just been paid. Interest is payable at the end of the next 3 years, and all of the loan notes are to be redeemed in cash at a 5% premium at the end of 3 years. So this is something to do with the loan note. Okay, so I'll just mention it here. Something to do with the loan note. The most recent dividend has just been paid. Dividends over the past 4 years have been as follows. So they have given me the oldest dividend and the most recent dividend. Chances are that I have to do the extrapolating of past dividends to get the growth. Okay. Current share price is 2.1. The loan notes have a market value of 97 and the preference shares are currently worth 0.85. So all the market values are here. Market value of the share, ordinary share, market value of the loan note and the market value of the preference share. Corp tax is expected to be 21% for the foreseeable future. Fine. Calculate the company's WACC. Explain your workings and any assumptions which you have made. Justify the basis of the weightings which you have used. Okay. So to do WACC, you need two separate figures. One is you need the cost of capital itself and you need the market values. Okay. So if you are going to take cost of capital in this particular question, there are three different instruments, right? We have ordinary shares. Okay, we have the preference shares. And you have the loan note. Three separate financial instruments. Now, you need to know the cost of capital of the ordinary shares, meaning you need to know KE. You need to know the cost of capital of the preference shares, which is KP, plus you need to know the cost of capital of the loan note, which is KD, if you remember. Okay. In addition to this, you need to know the market value of ordinary shares, market value of preference shares, market value of loan notes as well. If you have these two figures only, you will be able to calculate WACC. Okay. Right. Now, based on this information, let's do it one by one. Okay. So, if you need to know the cost of capital of ordinary shares, you need KE, right? If you remember in the cost of capital chapter, I told you there are two ways you can calculate KE. One is the dividend valuation model. Other one is what? PPIM. Okay. Now here I don't have anything to do with PPIM. I don't have betas. I don't have risk-free rates or anything. So definitely getting KE has to come from the dividend valuation model. Okay. Getting KP also dividend valuation model. Very simple. We'll do that. Getting loan notes, if you want to get KD, if you remember, you have to do an IRR styled calculation. This is something that was the basic thing that we did when it came to cost of capital. Okay. So now for each of these instruments, let's first get their cost of capitals, then let's get their market values, and I'll show you how to do the weighting for WACC. Okay. Right. So let me go to a sheet again. I think this was Oxfield Company. Okay. So let's start with the cost of equity. I'm going to get KE. Right. So to get cost of equity, I'll write down the equation that I need to use. Okay, so I need to find KE. I will have to use the dividend valuation model. Okay, so what is the equation? P naught equals to D naught times 1 plus G over KE minus G. So in this case, I am trying to make KE the subject of the formula. So I will do the rearranging as well. So KE should equal to D naught times 1 plus 1 plus G over P naught plus G. Okay, so both equations are given to you in your exam, so you don't have to worry about it. Okay, right. So now if I want KE, I need the dividend of the current year and the growth rate as well, right? So first let's see if we can get the growth. Right, so I know that the most recent dividend is 28.8 and the oldest is 23.5, right? So I can do the extrapolating of past dividends and go ahead and get the growth rate, right? So let me do that first. So to get growth, I'm going to use extrapolating past dividends. Okay, so I know that the current year's dividend was 28.8. Okay, and what else do I know? Let me just check that 1 second. Okay, there is a small catch in this question. Okay, they are telling me total dividend is 23.5, 25.6, 26.9 and 28.8. Now tell me this. When I usually do extrapolating past dividends, do I take the total dividend figure or the dividend per share figure? I take the dividend per share, right? I don't take 28.8 million as a whole figure, right? So here, since I am taking that 28.8 as a whole figure, I don't have a choice when I am using the dividend valuation model. Can you see that there is a P0 over here? That is the market price per share now. Instead of using the market price per share, I won't have a choice. I have to use the total market value of the company. Reason for that is usually D0 is a dividend per share. So this is P0, market price per share. But in this case, since I am given the total dividend, I have to be careful when I am taking P0. I can't just take the market price per share. I should take the market price per share into the number of shares issued. Okay. Right. So let's go ahead and get the growth rate. I'll take the entire 28.8 divided by the oldest dividend that I have is 23.5. Over to the power 1 over n. N is the number of years behind, right? So that is 1, 2, 3 years ago only it was 23.5. 1 over 3 minus 1. So the growth rate will be 0.07, which is 7%. Okay. So now I can just put in the figures over here. So D0 current dividend was 28.8 times 1 plus 7% over, usually I can put just P0, which is how much? They are telling me current share price is 2.1, right? So usually I can put 2.1, but in this case I will multiply it by the number of shares in issue as well. I will multiply it by 160 because I am using the total dividend, not just the dividend per share. Okay, so that will be 2.1 into 160 plus the growth rate, which is 7%. So that should give me KE. Okay, so KE, put this in your cal, you should get it as 16.17%. Okay, take it down and mention here why this 160 was multiplied as well. Okay, so number of shares. Reason is because this is the total dividend. Okay, so KE, I just highlighted it there, is 16.17. Cost of equity. Can we divide the total dividends? Yes. You can divide the total by the number of shares and then take DPS and then use the market price as it is. Yeah. That's fine. Okay, so that will be the cost of equity. So now let's do the cost of preference shares. KP we call it. That's very simple. KP, it has an equation equals to D naught over P naught. Okay, so let's look at the question. D naught, you can see it's 8% preference shares, $1 each. That means 8% into $1 is going to be the dividend for that particular preference share. Okay, so that will be $0.08. We can take it as cents because then it will be a round 8 figure. Okay, so the dividend will be 8% into 100 cents, which is 8. And if you look at the market value, they are saying preference shares are worth $0.85 per share ex dip. So everything is given to me here. So D naught, I'll show you how I got it. 8% into, I'll just take it in dollars itself, $1. So that will be 0.08. One second. 0.08. Okay, so that's D naught. P naught, they're telling me it is 0.85. Okay, so all I have to do is take 0.08 divided by 0.85. Okay, and multiplied by 100. That will give me KP. So KP is going to be 9.41%. Okay, so I'll just highlight it. That's KP, simple. So KE I have, KP I have. Now I just need the cost of debt. Okay, so cost of debt KD. So for KD we need to do an IRR style calculation. So how do we start, right? Right, so they are telling me the loan note interest for the current year is paid. Interest is payable at the end of each of the next 3 years. So for the next 3 years I have to pay interest, and all the loan notes are going to be redeemed in cash at 5% premium at the end of 3 years. So in year naught, the market value, currently the market value for these loan notes, they are giving it to me at the bottom, right? They are saying it is $97 today. Okay, the market value of the loan note is 97. Then year 1, year 2, year 3, I will have to pay interest, and at the end of that third year, I will go for a premium, meaning every loan note is worth $100. When I am doing the redemption, I will have to redeem at a 5% premium. Okay, so that's what they are telling me about this particular loan note. Right, so now let me put it into the IRR style calculation. So I'll have the years 0, year 1 to year 3, and then at the end of year 3 you have the redemption. So here I'll put market value, here I'll put the interest, and here we have the redemption at a premium. Okay, market value I know it was 97. How much is interest? I'll calculate in a bit. Redemption, they said it's a 5% premium. So all loan notes are $100. So when I'm doing the redemption, I have to do it at 105. Okay. Now for interest, they're telling me it's a 7.2% loan note. No. So 7.2% into $100, that will only be the interest that I have to pay. Okay. But that is before tax, I have to consider after tax interest. So that is important, right? So let me get the interest figure. Okay, so that will be 7.2% into 100. So that will be basically 7.2 multiplied by 1 minus the tax rate. Tax rate was 21%. So take that as well. Wait, I'll take it like this. I haven't multiplied it. Okay. So that will be 5.688. Okay, so I'll take it to 2 decimals. 5.69. So that will be the interest figure that I have to put here. Okay. So now I have to do IRR now. So for that, what do I have to do? I have to take 2 separate discount rates, get the present values and use the IRR equation. Okay, so let me take maybe 5% and 10%. So discount factor at 5%, present value at 5%, then discount factor at 10% and present value at 10%. Okay, so here not it will be 1, here also it will be 1. Then year 1 to year 3 is an annuity. So go to the annuity tables at 5% and get the figure. It will be 2.723. Okay, and year 3, at the end of year 3, that is going to be not an annuity, just the present value table. 5% at year 3 will be 0.864. Okay, so same thing, I'll get the numbers first. If I go to the annuity table for 3 years and I look at 10%, I get 2.487. And go to the present value table for 3 years, it will be 0.751. Okay, then you can multiply these two. And here multiply the cash flow, careful, with the discount rate. Okay, so now I can get the total NPV here. Okay, so I have a positive NPV and a negative NPV. I can use the IRR equation now. Okay, so what's the IRR equation? Okay, so IRR equals to the lower rate plus NPV at the lower rate over NPV at the lower rate minus NPV at the high rate times the high minus the low. Right, so we had two rates, 5% and 10%. Lower rate is 5% plus NPV at 5 is 9.21 over 9.21 minus NPV at the higher rate is minus 3.99. So minus 3.99 into higher rate, which is 10, minus the lower rate, which is 5. Put it in your calc. You should get the IRR, which is 8.49%. So that is basically the cost of debt. So KD actually 1 minus T because it's after tax, 8.49%. Okay, so now we have KD, we have KP, we have KE, everything that we need. So now just a matter of getting the market values and then calculating the WACC figure. Okay, so take this down and then I will show you how to get the market values. Okay, so now let's get the market values. Okay, so for equity, preference shares and the loan notes, I need market values. So market value. So market value of ordinary shares, market value of preference shares, and market value of the loan note. All of them I need them. Okay, so if you look at ordinary shares, I know that currently the share price is 2.1 and there are 160 million shares. Okay, so if I want to get the market value, it will be 2.1 into 160 million. Okay, so that will be 336 million. Okay, then market value of the preference share, I know that every share has a market value of 0.85, and how many shares do I have? You can see that it was $1 each, right? So 12 million means you had 12 million shares in issue. So 0.85 into 12 million. So that will give me 10.2 million. Okay. Then the market value of the loan note, you can see here they told me that the loan note is worth 97. Market value is 97. So if I know the number of loan notes that I have issued, I can multiply that by 97. I know that 67 million is the value of all my loan notes. Each loan note has a value of $100, right? So 67 divided by 100 will give me the number of loan notes in issue. That when I multiply it by 97, I should get the market value of these loan notes. Okay. So I know I have 67 million loan notes in issue, but that's a dollar figure. So if I want to know the number of loan notes, I will divide that by 100 first, and then I will multiply it by the market value of $97 per loan note. Okay, so that will give me how much market value of the loan note will be 64.99 million. Okay, so there you go. I have the market values, I have the cost of capital. It's easy to get the weighted average cost of capital. Okay, so how will I do that, right? So it's like this. You will have your equity, your preference shares, okay, and your loan notes. Okay, then put the market values first. So market value, when it was equity, it's 336, this is 10.2, and this is 64.99. Okay, so those are the market values. Then take the cost of capital. So if you look at equity, KE, we already calculated it. It was 16.17%. I put it here. Cost of preference shares, we calculated 9.41. And the cost of the loan note we calculated was 8.49. Okay, so now when you want to take WACC, this is what you have to do. You have to take the market value and multiply it with the cost of capital. So 336 into 16.17, that is 5433. You have to do it for all three. Okay, so now the next step is you need to take a total. Okay, so take a total for market value, which is 411.19, and a total here as well. Okay, so finally when you want WACC, all you have to do is take this total 6080 and divide it by 411.19. So that will give you the WACC, which is 14.78. You can take it to 1 decimal place. So WACC is 14.8%. Got it? This is how you do the WACC. I know there is an equation as well, but might as well avoid it, because if you are using the equation and there are a lot of instruments, you might go a little wrong here and there, right? So it's best to use the table, especially since we are having spreadsheets. It's faster to use the table itself. Got it? Any questions, guys? Guys, next week please learn and come. Okay, revision classes. There is no point coming for a revision class if you don't learn. You will be lost the whole class. Okay, so only if you know what is happening, you will benefit. You will ask the correct questions. You can, if you have any issues with the question, you will be able to clarify that and all of that. If you are trying to come to the revision class and learn, it's not going to help you. Okay, so please make sure next week you guys are properly, thorough with the syllabus. If not, it's not going to help. I'm telling you that again and again. Because if it's a revision class, so we will assume that you know the syllabus. We are trying to focus on the questions at this point. Okay? Right. So because there is no point doing more and more questions if you don't know the theory. You have to know the theory, only then you can do the questions. So that's why at the beginning I don't try to focus on the question, because if I do that, you will get completely lost for this paper, right? So that's why we make it simple, give you the theory, but now is the time for you to actually apply it. Okay? Right, so that's how WACC is calculated, and I think that question has a little bit of theory as well. So let me go through that. So what did they say? Calculate the WACC, that we have done, and they're saying explain your workings and any assumptions that you have made, right? So when you're doing WACC, there are a lot of assumptions that we make. So let me just show you the marking scheme. Where was that? Okay, just give me a minute. I will ask them to upload the answers onto the study hub, okay? Sorry, the LMS. Okay, so let's just quickly go through the answer here because it's all theory. Right, so assumptions, you can see when you're doing WACC, the formula for KE assumes that the future growth in dividend will be constant. We got the growth, we thought it will be 7% and it will always be 7%, not the case. Okay, then tax is assumed to be constant at 21%. Okay, we assume that the market price that they are giving me 2.1 is actually a fair representation, may not be the case. Okay, so if you can make 3 of these points, that will give you the maximum of 1.5 for the assumptions. And then basis of the weightings, can have a look at it. Both cost of capital and WACC have been calculated using the ex-interest market values rather than the statement of financial position values or the nominal values, right? So we are using market values and not the book values, first thing. The other thing is, this is to ensure that the current market cost of finance is determined rather than a historic cost. So you know, I hope you know that WACC, you can weight it in 2 ways, either using book values or market values. In the slides itself, I tell you the best approach is to go for the market value. So that's what they're trying to say here. We have used the market value. The reason for that is only then you will use the current market cost rather than the historic cost. So the WACC will be more relevant. Okay, so if you can mention that, that will be 1 more mark. So out of the 11, you get 2.5 marks just for the assumptions and the basis of the weightings. Okay, so that is one thing. Then the next part of the question is, explain how the PPIM model could be used as an alternative means of determining a suitable discount rate for the assessment of the investment, assuming this is a new direction for the business. So I explained this 2 weeks ago. I told you if you are going to invest in a new business area, doesn't make sense to use the WACC when you are doing the NPV calculation. Right? A better option will be to use this capital asset pricing model. So if you remember, that is where it says here KE, you can go for a project specific cost of equity if the project activities are different from that of the company. So what do you have to do? You have to find a proxy company, meaning a listed company who is in that line of business, take their beta equity, de-gear it, re-gear it, then use the PPIM equation to find a project specific cost of equity. If you can just mention all of those steps, it's a solid 4 marks for you. Okay, so you can say, see here, find a listed company with activities similar to those of the project. Look at the beta factor, adjust for gearing, put it into the PPIM equation. RF could be calculated using the yield on government yields. RM is calculated using the movements on the FT all-share index. You don't have to mention that. You can see that note isn't part of the 1 mark. Okay, so as long as you can say, put it in the PPIM equation and get KE, that is more than enough. Okay, so that will be your 4 marks there. Final part, briefly explain Modigliani and Miller's theories on how gearing level impacts the value of a business, right? So Modigliani and Miller, they said that there were 2 different theories on how gearing level can affect the WACC. As the value of a business can be determined by its future cash flows discounted using the WACC, the lower the WACC, the higher the business's value. Okay. So then they are explaining there are 2 theories. One is without tax and with tax. So without tax in 1958 they have said even if you use cheaper debt, that is going to be offset by the fact that cost of equity will increase because equity holders will see it as risky. So that way there is no impact of the debt equity structure when it comes to WACC. But after that 5 years later they adjusted the theory. What did they say? Cost of debt is cheaper and you also get a tax benefit. So because of that what happens? If you increase debt, you end up having a cheaper cost of capital because cost of debt being cheaper is more than the fact that cost of equity will increase. Okay, so that way what they are trying to say in the second theory is to gear up the company as much as possible. So you have to have at least 99.9% debt because the more debt you have, the cheaper the WACC is going to be. The cheaper WACC is going to be, the higher the market value of the company. Okay, so just go through what they have mentioned here. I will ask them to share this marking scheme on the LMS so you can have a look at it as well, right? So in case you haven't tried out the paper also, you can try it out and see how the marking scheme goes, right? Okay guys, that's it for this paper. So next week I will come with another paper which we can go through, and that paper will be a little bit more complicated than this one. So please make sure that you have learned properly. Okay, if not, you will be lost, you won't know what to do, right? So please make sure that you learn properly and come for that paper. By learning, I mean do more and more questions. Okay, right. Okay, then that's it for the day. I'll see you next Saturday, same time.